So you bought your home, you're excited, you're a first-time home buyer, and a year goes by and your payment skyrockets due to increased property taxes. But why did this happen? I'm Brand the Mortgage Man. I've helped more than 10,000 home buyers over my 20+ year career, and today I'm here to help you. So let's get right into it. So you bought your home, the taxes were low, your payment was affordable, your lender got you qualified based on where you said you wanted to be payment-wise, and a year later, that payment skyrockets because your brand new property tax bill was released, causing the payment to jump. But why did this happen? Well, the most common reason why that happens is because lenders will actually qualify you for a mortgage using the most recent property tax bill that's available. So I'm in Florida, so I'm just gonna compare it to Florida. So in the state of Florida, property tax bills come out in November. So if you're buying a home in March, the only tax bill that would have been available in March was from the prior year, November, right? So I'll give you an example. Let's just say the 2024 tax bill was $6,000. This was released in November of 2024. You're buying a home in March of 2025, as I said. The lender is going to use this tax bill to qualify you, $6,000, which would equal $500 per month as part of your monthly payment. Let's just say that this tax bill, right, from 2024, the owner of the property, which is what that's based around, was based on them buying the property for $400,000. So this tax bill of $6,000 was based on their value, purchase value of $400,000, however many years prior. Now you're buying the property in March of 2025. You're purchasing the property for $600,000, right? Because they've owned it for years, goes up in value, right? We all hope properties appreciate in value. You're paying $600,000. Now, if we look at this and say, okay, $6,000 to $400,000, this is 1.5%, right? Which is a common tax rate in Florida. Well, what does that mean for $600,000? Well, clearly, if this person is paying a 1.5% tax rate, why would you be paying less than a 1% tax rate or a 1% tax rate, let's just say? You're gonna be paying a 1.5% tax rate in reality, right? So 1.5% of the $600,000 you're paying would mean the taxes should be $9,000 for the year, not $6,000. However, if you're gonna have your taxes included in your monthly payments on your mortgage, the lender would have only been collecting $500 in your monthly payment to cover the previous year's tax bill. Well, now it's 2025, right? We'll say November of 2025. The new tax bill, as I said, came out and it was $9,000. Well, if it's $9,000 and you were only collecting $6,000 or based on $6,000, you're short $3,000, right? Negative. You have a shortage. So if you're in this scenario, you probably had an escrow analysis letter that you received from your lender. It said you have a shortage in your escrow account. The reason you have a shortage in the escrow account is for this exact reason. The new tax bill came out. You were collecting your escrows based on the old tax bill. The lender still had to pay the new tax bill. Even though you didn't have enough money in your account, they're not going to let the taxes go unpaid. So the lender paid the $9,000. By paying the $9,000, it left you short $3,000 in your escrow account. That's the account where your taxes are held by your lender. So how does this money get collected from you? Well, here's what's gonna happen. They're gonna take this $3,000 shortage, they're gonna divide it by 12, which is 1 year. 3,000 divided by 12 is $250 per month. This means that they're gonna take the $250 per month and add it onto your monthly payment for the following year. So we're gonna say January to December 2026, right? That would be the following year. The payment is plus $250. That's just for your shortage. What about the actual difference in the taxes? Because it's not just the shortage for the 1 year, you're short going forward. Well, now they have to collect the correct amount going forward for your taxes. So on top of the $250 you were short, they're also gonna collect the difference in the tax amount. Right? So that's your shortage. This is the difference. So in this scenario, your payment would increase by $500 per month, at least for a year, right? 12 months to collect the shortage. And then after that, it's just going to continue that extra $250 per month assuming that the tax bill doesn't jump up year after year. Now, if it's your primary residence and it's in Florida, like we're talking about, it can't go up more than 3% per year, assuming you took homestead exemption on the property after the initial adjustment when title changed hands, meaning that the seller sold the property to you, right? Transferred. But this is why you have that shortage. It's a combination of the lender not collecting enough because they didn't have what the new tax bill was going to be. Now, some lenders will let you collect based on the projected tax amount, which you can actually go on the county website, wherever you're buying, and run the tax estimator in order to see what the proposed taxes would be for the property. And you can ask the lender to collect your taxes based on that. But something you want to keep in mind, this isn't ideal, but I see it all the time. A lot of people who are buying properties always want to go to the maximum amount they can qualify for in mortgage guidelines. And the biggest piece of that is debt to income ratio, what you make monthly versus what you spend monthly, including the new property. Keep in mind that if you ask the lender to base it on the higher projected tax amount, it's going to reduce the amount you can qualify for because it's going to increase your debt to income ratio. So it's a double-edged sword. It would help you prevent having an escrow shortage, but it would also prevent you from qualifying for as much as you may want to qualify for, because you may be okay stretching yourself thin, or maybe you have a spouse who's not going on the mortgage with you, who has additional income. So your debt to income ratio seems high on paper, but not in real life, right? There's multiple reasons. But just keep in mind, if you want them to collect based on the higher amount from the start, it's possible, but it will limit your qualifications. But long story short, if you were wondering why your payment increased after your first year of ownership, this is likely the reason if you had a fixed rate mortgage. Now, what can you do when this happens? Well, you can call your lender and you can tell them that you're willing to pay the shortage in a lump sum. If you're in a position to do that and you're willing and able to pay the $3,000 one time, you'll only see the increase in this scenario of the $250 that your taxes actually increase, because you would avoid having to break the $3,000 up over the preceding 12 months. But maybe you're not in a position to do that. What's an alternative? Well, something that some borrowers will do is they'll reach out to the lender who helped them with their initial purchase and they'll refinance. So they'll get a new mortgage that will help them catch up on their escrows, avoid this extra $250 in this scenario increase. You can't prevent this increase in your taxes because your taxes went up, but you can get yourself caught up on what you were short in your escrow account, and then you'll want to see a $250 monthly increase in this example versus a $500 increase. So keep that in mind as a way to potentially catch yourself up. Now, if you're someone who doesn't want to see a jump in your monthly payments, something you may want to consider to avoid this is waiving escrow. This means that when you buy the property, rather than including the taxes and insurance as part of your monthly payment, you can opt to pay those separate from your mortgage once per year. That's called waiving escrow. Most lenders are going to require you to put 20% down to have this option. I know that we will allow it with as little as 3% down, as long as you have a 680 or above credit score if you're buying a primary residence. But that's specifically with us. Every lender is different. But waiving escrow means that it would not be part of your monthly payment and you would be responsible to pay those bills when they're due once per year. So just make sure you're someone who knows how to budget their money properly so you don't put yourself in a position where you can't pay those bills. Now, if you have more questions about mortgages and real estate, make sure to subscribe to this channel. You can learn things like I've talked about in this video today and really anything pertaining to the home buying process. And if you have questions about your own scenario, leave that question below because I do reply to 100% of the comments left on my videos.